the number of people who have found themselves bankrupt because they signed up to finance products to keep a non-viable business afloat for that little bit longer, to get over the little bit of a hump that hasn't worked, but as a result of the finance they've signed in, now they're bankrupt and now their home is on the line. And the cost to people's family and people's lives of not accepting the writing on the wall and going into those sorts of arrangements is incredibly high in, ruined families and ruined lives. Hi everyone, Liam Bailey here from O'Brien Palmer. Finance is becoming an ever bigger part of our job, and whether we're talking informal workout arrangements or formal solvency solutions, there's a role for finance to play at all points. And with changes at the ATO, finance is becoming a more critical part of business operations than ever before. So with that in mind, today I've invited Steve Godwin from Moneytech here to join us. Okay, Steve, how you doing?
Good, Liam. Thanks for having me.
No, thank you for coming along. Hey, Tom, why don't you tell us a little bit about yourself and about Moneytech?
Welcome all. My name's Steve Godwin. I work for Moneytech, a non-bank financier. We've got a range of products at Moneytech from sort of small businesses down to $50,000 up to $25 million facilities. I've been with the company for 4 years, recently in the low doc space. But I guess my background prior to that was in the distressed restructuring, turnaround, funding, which I did 14 years, primarily asset-based lending. So that would be your debtor finance, your property-based lending, and also some equipment finance. So I've been around for a little bit, a lot in that distressed sort of difficult style of financing needs for businesses.
The reason I like to work with Steve and people like working with Steve is particularly that background of with people in distressed situations. Steve is able to really understand the difficulties that business can face, and it helps him diagnose and find the appropriate finance products for people to solve whatever it is their problems are at the time. I started out by talking about the informal workout space. Now, for anyone who's watching, we're really talking here about people who are catching potential solvency issues or liquidity issues, cash flow crisis, but they're doing it at a point where it's really early. We haven't yet reached the point of defaulting on debts, paying creditors outside of terms, but we're looking at how a business is operating, how a business is funded, how it's capitalised, and before we get to the distressed market, we're looking at how to solve those problems. Who are the sort of people that are coming and seeing you in that space, Steve?
Look, we do get a lot of referral bases come to us when the ATO or creditors are at the early stage. So prior to any default judgments or anything like that coming up on creditor watch files or any files through the credit bureaus, to sort the issues within their business. So a lot of the times the businesses come to us, and there's an old adage or an old analogy from a while ago, symptoms and causes. So a lot of people come to us with the symptom. So the symptom of the problem when people come looking for finance is usually, I have a problem with X, and that is the symptom of the cause as to why they start the conversation with you. But what we need to work out is not necessarily what the symptom of the cause, and we always use the runny nose for when somebody gets the flu. So when somebody gets the flu, we look back and they say they've got a runny nose, that's the symptom, so we get a tissue to fix the runny nose. That's not going to solve the problem. The problem is your 5-year-old daughter went to daycare, picked up a whole bunch of germs, brought them back home, and now you have the flu. So a lot of times the brokers or the accountants or the advisors or the customers themselves will come back and they'll say, look, my problem is X, whether it be creditors or ATO. Whereas when we dig deeper, we need to understand it. I mean, you'd see it in your space, Liam. Maybe they lost their biggest customer. Maybe their best salesperson left and took some of their customers away from them. We have to understand as to why the ATO is the problem.
Yep.
And make sure we understand that so that we're providing the right solution, being we're not just throwing good money after bad at all the solutions that we get.
Look, that's very much in the informal space. Really the biggest task is to get to what is the key problem here. For example, I had someone in here today that says that their business is being stressful. It's been stressful to trade their business because collecting money from their customers is getting more difficult, and the amount of time that it's taking them to be able to collect on those debts is getting longer and longer, which is causing significant cash flow issues for them. And they'd be the sort of people who you'd be would come and speak to you, and you're diagnosing that is the problem, not just I don't have enough money, I can't pay my debts, but the why, and picking a particular product or solution to solve that problem.
Absolutely. So, I mean, debtor days are dragging out at the moment, and that could be the why. The why haven't we been able to keep up with our obligations, with our creditors, with our payables ledgers, with our ATO obligations or wages. So if we can go back to the root cause of why aren't they getting paid on time, it is really industry by industry as well. We see certain sectors that are doing really strong and debtor days are staying on top of them. And then there's other sectors that are really dragging out, and that's what we need to understand prior to coming up with a solution for the customer.
Now, one of the things that you mentioned before was about credit bureaus and credit reporting, and that is becoming a bigger issue and a more relevant thing for people to consider in trading their business at the moment. Can you explain a little bit about that and why it is becoming more important and more relevant to stay on top of how a credit bureau will report about your business?
Yeah, absolutely. There's three primary credit bureaus that financiers use, being Creditor Watch, Equifax and Illion. And what we found recently is the algorithms are getting smarter within these bureaus to pick up distress faster. And whether it be for monitoring current customers that you're providing funding for or originating new lens, all banks, non-banks use credit bureaus to make financial decisions for businesses. And I'm using the ATO as sort of the main driver of this, but when an ATO tax default gets put onto a bureau, it obviously becomes more difficult to get funding. And the pool of lenders that you have at your disposal originally decreases as soon as the ATO is seen on one of those credit bureaus. So they've been a big part of how funding is moving forward.
I know as well that a lot of people have said that if you're with a supply contract, that they will have alerts set up through credit bureaus, and the minute that any sort of adverse entry is put onto a customer's credit file, it is sent out to every single person that's set up an alert as part of their own risk management strategies. So those credit bureaus on which any sort of adverse event is recorded are being broadcast far further and far more broadly than they ever have been before, which is creating a risk profile for people that you're dealing with. So it's really important to stay on top of those things more than ever and prevent them from getting to the default stage.
Absolutely. And it's not just the financiers that are using these, so customers are using these. And if they see that one of their debtors are on there, they might pull credit terms or they might change the way that they're dealing with their customers, which also impacts their business, whether it be in a formal or informal sense before it gets to somebody like yourself.
Look, it's worth for anyone that's watching this, that's running a business, to have a look. Get onto one of these credit bureaus. The opening page of most of the credit reports that people are looking at will tell anyone that's looking with a degree of confidence what they think the financial strength of your business is, and that then becomes the basis for any risk profile moving forward. And so be aware of how your business is being reported through these and what that might mean moving forward for dealing with suppliers, with customers, with the tax office, and with anyone that you need to obtain finance from.
Absolutely. And it's not just that. What I would say is we've seen scenarios in the past where a customer's come to Moneytech or a lender such as Moneytech looking for finance, and there will be a default on there, whether it's a paid default or an unpaid default, which would automatically knock it out of our credit appetite. And what you can do is, if you be proactive about it, is get on top of it early. And we've seen deals come to us with a paid default on there that gets removed from the credit bureau, which turns the score around, gets it back within appetite, and really opens up that pool of lenders and financiers and how much you can get once you clear up anything that could be on those credit files.
Now, coming back to before, I said you had a case of someone who was saying that the problem that they're experiencing, the stress that's being caused, is by the delays in collecting the money. And one of the solutions that was proposed to them was some invoice financing. Now, historically, a lot of people have always thought that this is a finance product which is the death knell of a business. But I know that in the last 15 years and recently in particular, there's such a variety of products now around, and more people are taking it up than ever before as an integral part of cash flow management to avoid defaults. Can you tell us a bit about that?
Okay, so invoice finance has been around for a long time. As you said, back in the day it was called factoring, and a lot of factoring clients were seen poorly in market as being under distress or in some financial trouble. As you said, over the past 10 years, confidential factoring or invoice finance has come in, which means customers aren't aware of it. But the recent shift in the invoice finance market is really pushing up. So we've seen years gone past, $100,000 or $200,000 facilities for invoice finance are becoming less and less. And the facilities are really $500,000, $1 million, $2, $5, $10 million facilities. A lot in that invoice finance space because it's a really secure product. Financiers like it because they can collect out if anything goes wrong. But the shift has really gone in that sub $500,000 mark. There's a lot of new non-bank players. There's a lot more players in the space to take on risk where there might be some sort of turnaround or restructure, or whether it be formal or informal. And it's, like I said before, rate for risk. So you won't be getting your single digit rates for these types of customers. But in the $50,000 to $300,000 space, there's plenty of new players in the market that will take some additional risks when there is that turnaround or restructure. Invoice finance has always been a good, viable product for those bigger customers that have better controls in place, that can manage the invoice finance process.
So look, risk for rate's a great segue into the next section I want to talk about. And obviously everyone knows that the higher the risk, the higher the interest rates associated with any finance product are. And there are players in the market who aren't interested in being involved in financing people where there is a heightened risk. But there are obviously a number of solutions available to people who do find themselves in financial distress, who might have some adverse events on a credit file. What are the types of solutions that people are looking for in the distress space, and what are the sort of products that might be available to help them?
25 years ago, GE used to have two types of products in market. One was recovery in the event of default, and one was risk of default. So obviously if the risk of default was low, they could offer a low interest rate on really strong products. But when we're talking in this sort of sector, it's always recovery in the event of default, which means if this doesn't work out and the turnaround structure or the symptoms and causes that we spoke about before doesn't send the business in the right direction, how do we recover our money? So that's always recovery in the event of default is the only way that you can look at what products are available. So invoice finance that we've touched on has always been a good one. It's secured by receivables and an all-pap over a business. So there's always a way to recover your money. And then your traditional forms of finance, such as your property lending or capital raises against existing fleets of equipment, anywhere where there's a secondary exit. So the primary exit is obviously the business paying the funds back, and we all get out the other side and everybody's happy. But we know in an increased heightened risk type of business, such a restructure or a turnaround or even a formal deed of company arrangement, there needs to be backup security that if this doesn't come out the other side, how is the financier going to recover those funds? Whether it be from debtors, property or equipment are probably the three main ones that come to mind.
Now, with the broad variety of finance products available and different people that will lend with different profiles and different rates, obviously lenders don't want to finance people where they think that there is a significant concern that they're not going to get their money back. It's somewhat of a truism of our industry when we're talking to directors and giving them advice is that if you can't obtain finance, if you can't find someone who will lend you something at a cost that you can afford, then you have to have a look at what is the real issues that you're confronting here. Because there's a market out there and you can get finance one way or another almost anywhere, but the cost associated can be too high for it to be a viable solution. Now, there's lots of lenders out there of last resort, and they are preying on people's desperation, their hopes, their fears, that people find themselves signing up to finance that is ultimately buying a small amount of time but at a huge cost. Certainly not one that's worth embracing. So if you're in a situation where someone, has got financial problems and you can't find them a solution or a financial product, what sort of message would you give to them about moving forward?
We always say you don't throw good money after bad, which means if a business is struggling and the underlying business itself is not profitable and it's not coming to become profitable. I've seen recent scenarios where we've looked at a transaction, it's outside of our risk appetite because we've seen the business was heading in that direction. And an insolvency practitioner has come in and given some advice on what the business should do to restructure. And then outside of that, one of these lenders come in, these sort of, we call them rent-to-own lenders, where they throw good money after bad, that they have the security there. They toe the line for an extra 3 or 4 months where they know where it's going to end up, and then a formal appointment happens after that. So we try to stay away from that and steer, but it's really your trusted advisors that we always say you have to have the right people in your corner. It's not about me knowing everything about insolvency practitioners or accountants or lawyers or you knowing everything about finance. It's about having the right people in your corner to be able to pull on and leverage so that they can give the right advice. and you've just got to trust those people in your corner.
Look, I can tell you from the perspective as putting on my hat as a bankruptcy trustee, the number of people who have found themselves bankrupt because they signed up to finance products to keep a non-viable business afloat for that little bit longer, to get over the little bit of a hump that hasn't worked, but as a result of the finance they've signed in, now they're bankrupt and now their home is on the line. And look, the cost to people's family and people's lives of not accepting the writing on the wall and going into those sorts of arrangements is incredibly high in, ruined families and ruined lives. So I really encourage anyone that's watching this and is thinking about taking out finance in desperate situations to really, really think about the potential consequences and whether it's what they want to do. Because if there's not an affordable finance product for you, it's probably because there is a fundamental underlying problem that finance isn't going to address. One of the last things I wanted to talk about with you today, Steve, is there's been significant changes in policy at the ATO that are driving people to have more discussions about how they finance their business. What can you tell us about what's been happening at the ATO and what you're seeing as the changes in the market because of them?
Yep. From June 30 last year, tax debt is no longer tax deductible. It's a marketing ploy for a lot of the financiers out there to get out and let everybody know that.
Naked pitch.
Exactly right.
Yep.
We're here to pay out that ATO debt and potentially end up cheaper once our interest rates are tax deductible. So there are a lot of lenders, especially in that non-bank space, that are happy to take on some form of ATO debt with early intervention. So once it's gone too far, once it's outside of the 2, 3, 4 months worth of revenue number, it's hard to keep up with your current obligations and chase back the outstanding arrangement or debt. So we need to understand, first of all, again, we go back to the good money after bad. We want to make sure that there's a viable business there. We understand why the tax debt has rose to the point that it's rose to. We may need to make sure it's manageable, and we need to make sure that we can get out the other side. So yeah, the ATO debt is definitely a big talking point in market for a lot of financiers, especially in the non-bank space, because that change has made it a viable option to not just go down the route that you've always gone down, which is continue to pay the ATO. There may be better overdraft facilities that you can draw down on, pay down quicker, reduce the amount of interest, and essentially put the business in a stronger position moving forward. There are predatory lenders out there that we really want to get away from and try to show to market, look, insolvency is the same, accounting's the same. There are lots of sort of people in the small percentage of businesses out there doing that, but we're trying to show to market, look, if you're going to deal with these guys, you're wiping Money Tech out.
Yeah.
You're wiping some of these bigger companies that have been around for a long time out of your pool of lenders for this customer if you go down that route. So it's about changing behaviour as well in that space.
Look, that's really great advice. I know that there are plenty of people who are looking to obtain finance to pay down tax debt because their interest payments become tax deductible with the finance from a third-party source. And I get asked about that all the time. So if that's you and you do need to speak to somebody about that sort of thing, you'll find Steve's details linked here, and please don't hesitate to get in touch. And as we said before, as one of the major strategies that the ATO have to get people to come to the table and pay debts on time has been reporting on tax defaults and tax debts owed to those credit bureaus. And once they're on there, that does make a lot of the solutions a lot more difficult. So it's really important to have these conversations and think about them before we get to the point of defaulting on our tax debt or repayment arrangements to prevent that making your life harder down the track if you do need some help.
And as soon as you come into an SBR, it's a formal application to have somebody come in and help out with the business. And as mentioned before, rate for risk, you do knock out a lot of lenders out there in market. There are a lot of lenders in market that won't play friendly in the SBR space. But there's also other great lenders that will assess a transaction on the viability of a business moving forward. So we saw a lot coming into COVID. There was a lot of the renewables and solar where businesses would have a lot of CapEx expenditure up front, setting up the business, getting it all ready. And when it came time to essentially turn in a profit, they'd run out of money. A creditor would be chasing them. They'd get some advice to enter an SBR. So we saw a lot of facilities being set up that as the SBRs were entered, if there was a viable business there was a good strength of debtors. You need to look at what is the spread of the debtors, who are the debtors, and is there any additional security? Going back to my point earlier, if there's some form of secondary exit by way of a property or some equipment, your pool of lenders increases, and there are viable options out there to get funds into the business to not just mask the problem, but to actually toe the line down, get them through that point being the SBR, get out the other side, and then turn a profit and get away from that lender over a 12 to 18 month process. So that's always the way that we look at it when we're funding through an SBR, is it's never a forever facility. It's a time and place to get a business through. And once it gets out the other side is you start looking at your options, whether you can cash flow forecast and cash flow fund the business moving forward, or whether you may go back to a traditional form of finance such as a bank or a credit fund. So those are always the options out there after SBR funding.
So I have a director. I was appointed small business restructuring practitioner here about 3 months ago. The business was a surveying business. They entered into an SBR. The ATO was the principal determinant of whether or not the SBR is going to be successful. They weren't particularly interested in a business restructure that saw future profits applied over a period of 12 to 18 months. They wanted a cash sum up front. So we were able to find them finance. They put a lump sum payment in to the Small Business Restructuring Fund. The ATO accepted it. The director will now pay back over the next 12 months the finance that they obtained to fund that lump sum payment in the small business restructure, with the idea being that at the end of that 12 months, if there is still money owing, they'll be able to refinance again into a more mainstream finance product with a lower interest rate to move forward. So that was one way in which a director has used the availability of finance to fund a workout solution, but not find themselves trapped in high interest rate products indefinitely. Steve, I really appreciate you taking the time to come in today. I think you'll find that a lot of people find that really, really useful as they start to contemplate a changing business environment and how these sorts of products are becoming an integral part of trading the business today. So thank you for coming along. And guys, if there's anything that you want to get in contact with Steve, as I said, his details are down here below, and don't hesitate to give him a call or get in touch. Thanks, mate.
Thanks, guys.
Becoming a bigger part of the way that we do our jobs. What are you?
He just looks so stupid.
He's so staunch, right?
I know. I gotta act staunch. Okay.
Okay. No, don't.
So close to each other.
I pride myself on being upright. Yeah. You reckon be careful? I'm gonna get sued by bloody or.
No, we didn't.
I didn't say that.
David, story.
I mean, I talk pretty loud anyway, so.
Sweet.
Droney.
No one likes to hear their own voice.
I know. Yeah, okay.
It's just
We've got to be doom and gloom. We're the OVP. We want to give you a little bit of up and then a whole bunch of how we fix the downs. That's.
Have you got one you want to chuck in?
No. No, I can't do it. I can't hold my breath that long.
I like the sound of my own voice sometimes, don't I? Are we good?
Perfect. You give me.